Alrighty, welcome back, and you are in the module. We are going to talk about entity selection part one, picking your legal entity, sole proprietorships, and partnerships. Disclaimer: this training is informational only. It does not constitute legal or professional advice. You are encouraged to consult with a licensed tax professional, enrolled agent, or CPA if you have specific questions relating to any of the topics covered in this presentation. Very, very important with this module, especially because we're going to talk about a lot of decisions that are going to be very specific to your personal situation, and picking a legal entity is going to be based on several different factors, and I'm just sharing some general information with you, so you can't just use this information solely and just go ahead and make a decision. You can, but I would still recommend working with a professional. All right. So, sole proprietorship. A sole proprietorship is an unincorporated form of a business with one owner. For tax purposes, the income and expenses of the business are reported on the personal tax return of the owner. Schedule C or a 1040 are the forms that you need to be familiar with when it comes to being a sole proprietor. In addition to income taxes, the sole proprietor is also subject to self-employment taxes at the current rate of upwards of 15.3%. And obviously, as you know, this rate may increase, and it probably has increased since you've watched, depending on when you watch this video. Liability protection. We're going to talk a lot about liability protection in these modules. And essentially what that is that it creates a separation between you and your business. And why that's important is if you business happens to get sued or you get into any legal troubles, the individual suing you has the ability to attack or get at your personal assets, which is money in your bank account, your home, and you don't want that to happen. All right, it's not a good situation to be in, so you want to make sure you have liability protection. And in the case of a sole proprietor, like I mentioned, it is not a separate entity from its owner. But single member LLCs, LLPs, which I'm going to talk about, they're separate from the owner, even though for tax purposes it is not treated as a separate entity. We're going to talk about those later on. Taxation of a sole proprietor. So the sole proprietors are subject to 4 different taxes. So you have the federal tax, state tax, depending on the state that you're in. Some states you're not required to pay any taxes. Social Security and Medicare. And for tax purposes only, a sole proprietor includes a single member entity such as a limited liability company or a limited liability partnership, which has elected not to be taxed as a corporation. The default tax classification of a single member entity is SP if the owner is an individual or branch or division of a business entity. All right, so a key distinction here when it comes to how your taxes are paid. So you can either be taxed as a separate entity, or you can be taxed as a pass-through entity. So separate entities kind of when you get taxed twice. So the business gets taxed, and then you get taxed as an individual from the payments from the business. Pass-through is when you are getting paid just taxed one time, okay? And with sole proprietors, you're getting taxed just one time through your business. And for owner's compensation, how do you get paid as an owner? You take what are called draws. So you are drawing money out of your business, all right? So you're not necessarily getting paychecks. You're just drawing money out of your paycheck. So fringe benefits. Fringe benefits, as a sole proprietor, you are allowed to have some fringe benefits if you're on W-2. And depending on your city, you may be required to have to take out a business license in order to have fringe benefits. So just keep that in the back of your mind. Not very important, if you are, kind of just starting out, but just something to consider and ask your tax accountant about. All right. Partnerships now. So we're going to talk about partnerships, another legal entity you may consider, and this is really just essentially just a business with 2 individuals. And a general partnership is an unincorporated entity, either U.S. or non-U.S., with at least 2 owners. So you have to have at least 2 owners, which is organized to carry on a trade or business. A general partnership is not registered in a specific state since there is no formal registration required to form a general partnership. Instead, a general partnership comes into being as soon as 2 or more persons join together to own or operate a business. All right, ownership of a general partnership is in the form of partnership units, shares, or percentages. A general partnership must have at least 2 owners, as I mentioned, but there is no upper limit on the number of members. So you can have as many people as you want, but it has to have at least 2. In addition, there are no restrictions on the kinds of owners that can be partners. Liability protection. So general partner ordinarily owns its assets, although not always. Sometimes property is held in the name of the individual partners and is used in the partnership. A general partnership is normally responsible for its own debts, that is, money that may be borrowed in the name of the partnership. However, general partners are personally liable for all partnership debt. This is recourse debt. So, like I said, if anything happens with the business, any legal actions are taken, your personal assets can be taken, or people can go after those. Okay, so just keep that in the back of your mind. Transfer of income to partners. So a general partnership can hire employees who are not partners. Partners, however, are not employees. All right, so they are considered partners, and such partners may provide services to the partnership and be paid for those services. However, the partners are not classified as employees. So just keep that in the back of your mind. Employees of a general partnership are eligible to receive a variety of tax-free fringe benefits, such as health care. However, partners cannot receive these benefits tax-free. Both partners and employees, however, can participate in company-sponsored retirement plans. So again, maybe not something that you're going to be thinking about as you start your business, but long-term, this is just good information for you to know. So taxation of a general partnership. Taxation of a general partnership is a general partnership does not pay. So basically, taxation of partners of a general partnership are taxed directly on the partnership income. Partners are taxable regardless of whether that income is distributed to the partners in the form of cash or property. Like a sole proprietor, a partner is also subject to self-employment tax of upwards of 15.3%. Partners can deduct on their personal tax return losses recognized at the partnership level. This is one of the great advantages of a general partnership. However, the ability to deduct losses is subject to a number of limitations. In general, partners can deduct losses equal only to their investments in the company, so in the form of capital contributions and share of partnership level liability. In addition, partners are limited in their ability to deduct losses if they do not actively participate in the business. So as you can see, the government or the IRS wants you to meet certain criteria in order to be able to deduct those losses. So as long as you're meeting those as long as you are meeting those requirements, you can go ahead and take the losses. Liability protection. As I mentioned, very similar to the sole proprietor, there's essentially none. Your personal assets can be taken. All right. So limited partnership. When the liability of partners for the debts of the partnership is a problem, a limited partnership may be a solution, but at a cost. Limited partners are generally not liable for the debts of the partnership, but they must restrict participation in management of partnership or risk loss of their limited liability. In addition, a limited partnership requires at least one general partner. Although the use of a corporate general partner provides a solution to problems, it also introduces some complexity. An LLP, okay? So a limited liability partnership is a hybrid entity that confers partial limited liability to members, and for tax purposes can choose to be taxed as either a corporation or a partnership. A limited liability partnership is created under state law by registering it under the state as a LLP. These entities are similar to a limited liability company LLCs. However, the liability protection is not as complete as the LLC. So LLC is going to give you more of that protection, but the LLP gives you some protection as far as partnerships are concerned. In general, LLPs operate and are governed by the same rules applicable to general partnerships. Therefore, LLPs are essential general partnerships with the addition of a liability shield. Owners' compensation. So in a partnership, partners are also compensated through draws, but they can also receive guaranteed payment to partners, right? And you can take money out anytime you choose. So there doesn't have to be, you don't have to get paid like on a biannual basis, weekly basis. Whenever you decide to draw money, you can do that. But you want to make sure, because you're able to do that, you want to make sure you draw up a partnership agreement which states when you can draw money, what are going to be the guaranteed payments that are made to each of the partners, just so you guys are on the same page. And that's probably one of the biggest risks that I find with partnerships, is that it all sounds good in the beginning, and you say, yeah, we're going to do things this way and you're going to do things that way. But if you don't have anything written up in paper and in documentation, then that's just going to lead to a lot of headaches. People get, some amnesia when it comes to when money's concerned. So just keep that in the back of your mind. Fringe benefits. Also, for some fringe benefits, it's going to work the same way as it does in the sole proprietor. So just keep that in the back of your mind. Alrighty. So that concludes this module. Really, really quick, I wanted to introduce those two, and we are going to jump into the other legal entities. So I hope you enjoyed it, and I look forward to seeing you in the next module. Take care. Bye.